the market actually in the first quarter has played out largely as we expected coming into the year. So entering the year after a fabulous performance by the market in 2013, we were more conservative in our expectations for the year. The market's actually been fairly flattish. I think you've had you've had a couple of different polls pulling the market. On the one hand, there continues to be investor enthusiasm and in a recovering economy. On the other hand, the economic recovery is still slower than we'd like to see, and you have some of these geopolitical concerns. We're rarely making radical changes. We like to move gradually and in a disciplined, prudent manner. So we have made some changes. We've made several modifications, both on the sell side and the buy side. On the sell side, we've sold a few securities that we believed would really underperform in a rising rate environment. And we've known for some time that the monetary policy that has been in place by the Fed over the last several years has been incredibly accommodative. We've all known that at some point that would end. And it's clear now that we're getting closer to the end of that. And so we've exited a few securities that we think would underperform in that environment, particularly securities like in the utility space, for example. And we've added to a couple names that we think first of all, will hold up well in a rising rate environment. And second of all, where we've just had opportunities because over the last few months, even while the overall market has been, for the 3-month period, has been flat, there have been times when things have gone up and things have gone down, and we've been able to take advantage of some of those weaker spots to add to names we really like. We think that the market right now is between fairly and fully valued. And what we mean by that is, if you look over the long term, the average range of the market, PE multiple is a common multiple we talk about, has probably been in the range of sort of 13 to 17 or 18 times. And today the market's at 17 or 18 times earnings. So at the upper end of that range, which makes us feel like the market's a little on the full side. But it's important to keep in mind that, so while that would be on its own makes you more cautious, corporate America is in fantastic shape. The balance sheets are strongest they've ever been. Profitability is very strong, so that makes you feel better. And to put that within perspective, at 17 or 18 times where we think the market is somewhat full, it's nothing like in 1999 tech bubble when the market was at north of 30 times earnings. So, we're on the fuller side of fair value, but we don't think it's outrageous. Our outlook for the years to come, I think, is consistent with what we said coming into the year, which is coming out of 2013. If you think about it, 2013, really 4 years into a bull market or into a market recovery, right? So from the depths of the financial crisis in March of 2009, we've had 4+ years of market recovery, and the market's done very, very well. We're gratified by that, but anytime we've had a market doing that well, it makes us more cautious as we go forward. Sitting here at the end of the first quarter, our outlook for the year is consistent with what we saw at the beginning of the year. And that was actually, our expectations were relatively muted, especially when compared to 2013. So as we all know, 2013 was a fantastic year for the markets. The stock market was up north of 30%. We don't expect that to be repeated. Rather, we expect the dividends to be a much stronger component of total return in 14 than in 13. And one way to think about that would be if you look back over time, over very long periods of time, the dividends have contributed about 40% of the total return for the market. So, for example, just to use some easy numbers to make the case, if over a long period of time, for example, the market had gone up 10%, with this understanding that 40% of the returns have come from dividends, you could think of that if the market's gone up 10% over a very long period of time, 4 percentage points of that came from dividends and 6 percentage points of that came from capital appreciation. Last year, 2013, the market was up north of 30%. Obviously, the vast majority of the returns was coming from capital appreciation, not dividends. This year, we would expect a much more significant portion to come from dividends. The golden age of dividends, in our view, is not actually a short-term thing. We think that this is a situation that will continue for many, many years. And you can think about it almost a bit like a pendulum. If you went back several decades ago, dividends were a huge part of equity investing. A big part of the reason people bought stocks was for the dividends. And the pendulum was over here towards dividends. And then through the 80s and 90s, the pendulum swung the other way. And you can think about the 90s and the early 2000s as a period where, when you're at cocktail parties talking about stocks, nobody was talking about how exciting the dividend was. The pendulum is swinging back the other way. And we think this type of trend often lasts many, many years. And what gives us confidence in that assessment is a few things. First off, the dividend payout ratio is very low by historical standards. The payout ratio is, if you think about it, for every dollar of earnings that a company's earning, how much of that are they paying out? Over a long term, it's been closer to 50%. And today it's about a third. So in other words, companies that are making $1 are only paying out about 33 or 35 cents of that dollar, which means there's a lot of room for them to continue to grow the dividend. The second reason we think there's a lot of momentum here is investor enthusiasm for dividends. in a world like today where it's hard to find a lot of good income alternatives, a lot of investors are asking companies to increase their dividends or put a greater emphasis on dividends because they need that cash to make up for lower cash returns they're getting elsewhere. And the third real reason is that capital intensity of American business is less. So if you think about it, dividends are really a byproduct of what's left over after companies made all their money and figured out how they need to invest that in their own operations. What I mean by that is, if a company made $100 but needed to build a new factory for $150, they may not have a lot of cash they could return to shareholders. Today, we find a situation where that same company that might be making $100 doesn't have a big call on that capital in its own operations. In other words, because of the advances in technology, globalization, the ability to produce products abroad, companies don't have a lot of calls on their capital internally. So they find that if they make $100, they don't have to spend that much of that growing their business, and they have a lot of that to get back to shareholders. It's interesting. If you look at corporate fundamentals, broadly speaking, corporations are in great shape, and balance sheets are really as good as they've ever been, and the American financial system, the banking system, is stronger than it's ever been. Post the crisis, companies have had to reinforce and replenish their balance sheets, and they're really sitting on a lot of cash and relatively little debt. So that makes us feel pretty good. I think the real concerns we have would be a couple. So the first off would be we continue to be disappointed, although not surprised, by the relatively slow pace of the economic recovery, both in the U.S. and abroad, number one. Number two, the monetary policy, both in the United States and across the globe over the last many years, this incredibly loose monetary policy, this zero interest rate environment, is a very unusual environment, one we've never been in. And we don't really know what's going to happen when we end that. So that gives us a little pause. And then I think the third thing would be some of the foreign things going on. So, while the European situation, the economic environment there seems to be getting better, we still have caution over that, or we're still concerned about that. And we worry about, a slowdown in China and the impacts that could have. So those are really kind of the things we're watching.